You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. The Atlanta Fed publishes a GDPNow model that estimates current economic growth up until the advanced quarterly GDP release. Because of its solid track record and the fact that it updates after each important monthly data report, GDPNow has proven to be an essential tool for market participants and economists who are trying to gauge economic strength in real time. The model's estimates are also a helpful way to measure the relative importance of different data surprises, especially when certain reports do not adjust for inflation on their own. On today's episode, we talk with Patrick Higgins, policy advisor and economist at the Federal Reserve Bank of Atlanta and creator of GDPNow, about how the model approaches forecasting differently than other models, how he evaluates the reliability of its different components, and the challenges of forecasting through the pandemic economy. Stay tuned. Coming up soon, our interview with Patrick Higgins, policy advisor and economist at the Federal Reserve Bank of Atlanta. But first, a quick market update. Companies added 142,000 jobs in August, according to this morning's employment report. The gain was an improvement from July's 89,000, but still fell short of the 165,000 consensus expectation. The unemployment rate ticked down just barely from 4.3% to 4.2%. Taken to the second number past the decimal point, the change was from 4.26% to 4.22%, not much of a change. The report confirmed data elsewhere that shows labor market softening. At the time of our recording, markets were still unsure whether the Fed was going to cut by 25 basis points or 50 basis points at its September meeting. The latest jobs data were in the spotlight more than usual after Chair Powell's Jackson Hole appearance 2 weeks ago, when he said that the Fed did not want to see any more weakening in the labor market. His comments were notable after inflation being the Fed's singular focus of policy for the last few years. They also showed that the Fed's view of the labor market is coming into better alignment with financial markets, who have thus far appeared more worried about the rising unemployment rate than the Fed. Last week, the first revision to second quarter GDP showed stronger growth and slower core PCE inflation than originally reported. Perhaps most importantly, personal consumption growth was revised upward to 3.0%. A solid sign that underlying private demand is strong and that Fed policy is not yet so restrictive that it has tipped the economy into a recession. Treasury yields on coupon securities fell 15 to 20 basis points across the curve during the last 2 weeks. After Powell's Jackson Hole appearance, the appearances from Fed officials did little to change market expectations for monetary policy. The secondary economic data, like the ISMs, ADP, and JOLTS, showed a mostly cooler economy, as did the Fed's latest beige book. The bond market reacted only incrementally to these reports ahead of the much more important employment report this morning. The initial reaction to today's jobs report was a bull steepening in the Treasury curve. That's all for the market update this time. Now our interview with Patrick Higgins. Our guest today is Patrick Higgins, policy advisor and economist for the Federal Reserve Bank of Atlanta and creator of the Atlanta Fed's GDPNow model. Patrick, thanks for coming on the podcast.
Thank you for having me.
Our topic today is estimating quarterly economic activity, also known as gross domestic product or GDP. Those of us at FHN Financial are big fans of the GDPNow model, as I'm sure a lot of our listeners are, so I'm very excited to better understand its mechanics. Patrick, the GDPNow model is often described as a nowcast rather than a forecast. What's the difference?
I would say a nowcast is generally describing something that's in either the very near future or in kind of contemporaneous with current time, so within the current quarter maybe, or even possibly a period that's just recently ended, but you don't have the data yet released. Whereas a forecast is at least one or more periods out from where you are currently, I would say. No hard and fast rule separating them explicitly. But a nowcast would be something like the current month or the current quarter or something like that generally.
And I think a lot of people look to the Atlanta GDP Now forecast, like those of us at FHN Financial, because it really has these real-time updates from monthly data. Now, any GDP forecast or nowcast has to make some sort of assumption about how the data will come in the rest of the quarter. In fact, as I think you even alluded to, the GDP Now model has an estimate for quarterly growth before we see any data. So the blue chip forecasts from outside firms will fill the data gaps using estimates for where they think the trends are going. And usually these are shops that have forecasts maybe a year, 5 years out. How does your model differ from how most forecasters choose to make these estimates of the kind of assumptions of how data will come in the rest of the quarter?
I would say for most of the monthly variables that go into the model, they're forecast with something called part of it's kind of the past pattern or trend in the data. So there'll be a part dictated by that. So some series, if they go up and have been going up in previous periods, they continue to go up just in a trend analysis, and that might be what the model forecast. Or some actually, if they have a high quarter or high month, then they might come down a little bit. Just kind of based on past patterns, it would kind of extrapolate that. And there's also a factor model, essentially. So there's something called the Chicago Fed National Activity Index. It essentially takes a bunch of indicators and averages together, and some indicators that generally are more informative get bigger weight than others. So something like employment or industrial production, series like that get bigger weights than some others. And so GDP Now has its own analog to that that's pretty highly correlated with that Chicago Fed National Activity Index. And that's also used as an ingredient to forecast the data of each of the series. And the forecasting model kind of assigns weights based on some regression on which of those variables, either the past patterns or that National Activity Index like variable, and then essentially uses that regression to forecast it.
Something that I think really benefits the GDP Now model is it's kind of relative simplicity. So really using the hard data. And when I think about a lot of the other models out there that try to forecast, they take these extravagant calculations using financial market indicators, maybe the number of mentions of layoffs in earnings reports. They really try to kind of concoct this very complicated stew to figure out where the economy is going. But the GDP Now model only uses the hard economic data. And as far as I can tell, there's one exception to that, which is the ISM surveys. And so, of course, these don't include what we would call hard data. They're surveys of decision makers at different firms. There's nothing that goes from those surveys into the BEA's GDP calculations. What is the thinking behind their inclusion, since it seems to be an exception to the rule that GDP Now only factors in data that have actually been released?
The main reason, I guess there is some other forecasting literature on GDP that does use that survey-like data before it. And I guess the advantage of that is it's released before kind of the hard indicators are released. So the ISM, I think, is released on the first business day of the month. And so that it has kind of an informational advantage over some of the other indicators in that sense. It's only used to kind of forecast the data that hasn't been released yet. So kind of at the beginning of the quarter, the ISM variables can play a larger role because there's months you have to fill in with numbers that you don't have yet. But kind of at the end of the quarter, it makes less of a difference because you're either forecasting 1 or 0 months of data essentially. So it's only used to forecast data that hasn't been released yet. There are some other, I think, surveys that are in that factor model, but it is generally, you're right, that is generally hard data. The predominant reason is kind of the timeliness of the series.
That makes sense. So it might be extrapolating the prices paid component as a proxy for inflation, or maybe the new orders components for consumer demand. And then once we actually have those data reports from the BLS or BEA or Census Bureau, the ISM's impact on the model kind of fades away entirely or just partially. Is it meant really just to get a head start on data that's going to come out in a few weeks?
Not every single series for the GDP release is actually released. You might only get 2 out of the 3 months of data. It could play some role, something like construction spending. I think the 3rd month of data comes out after the GDP report. They'll say these are the assumptions made for these variables that aren't released yet. The ISM could still be generating part of the forecast for that. But generally speaking, that's correct. There's 3 months of data, and there's really nothing left to forecast for, a particular subcomponent of GDP, then it wouldn't play any role anymore.
Something that I think has really come up during the last few years is people have had to adjust their interpretations of data releases now that there is actually inflation that has been quite substantial. And so I think of reports like retail sales or durable goods orders that are reported in terms that are not inflation adjusted. But when we think of GDP, it's usually the inflation adjusted number. And so does the GDP Now model account for price changes, or how does it bridge that gap between what is released only in nominal dollars and then estimating GDP that is adjusted for inflation?
Yeah, so I would say for most series, the BA does have a handbook of methods, so they do kind of provide price deflator information, and very often those price deflators come from like either the producer price index or the consumer price index reports, and then sometimes the import and export prices. So the GDP Now essentially does kind of the same, treats kind of the nominal spending variables and the price variables in kind of the same way. Takes whichever element of the price reports that's relevant for particular subcomponent of GDP and uses that to the extent that it can. There might be a few series where either the deflator, there isn't any information on that, and so you would extrapolate kind of a past trend. But for the most part, there is something from one of those reports I mentioned, and so the price deflator is going to be use information from that, generally speaking.
I want to talk a little bit about the track record of the GDP Now model, because I think something that makes GDP forecasting so interesting is that the official data are so subject to revisions for such a long period of time. And so that advance release for quarterly GDP that comes out a month after the quarter ends could be totally different than what the final estimate is much later. Do you find that the final estimate of the GDP Now model, which I think you update probably the day or two before that first advanced GDP release, does that fit best to the first advanced release? Does it perform better with one of the later revisions, gross domestic income? What kind of captures, what does the final estimate of GDP Now capture the best when it comes to all the different updates to GDP?
I guess based on past performance, it's been more accurate. It's been closer to the first estimate than the second estimate, and then the second estimate's closer to that one than the third, and the third one is closer to that one than the kind of the current vintage estimates. I guess kind of makes sense because the data the BA is actually using is the same data that the GDP Now is using for the first estimate. That's not the case as you get more and more estimates. Either there's data that's being used that GDP Now didn't have, or that data's been revised and GDP Now didn't have those revisions, essentially. So it makes sense intuitively that it's kind of closer to the first estimate than it is the later ones.
Yeah, that is intuitive that it's including the monthly data that we have initially. And of course, and so the data that's out there is our best guess at the point because it's unrevised.
I should make clear that it is treating kind of those initial estimates or initial releases of data as kind of hard data, and it's not trying to anticipate any revisions to those numbers, essentially. So even if those revisions were predictable, the model doesn't try to make a prediction of those.
So during the pandemic, something that has really plagued data collectors is lower survey response rates. And I think for a lot of people who aren't aware of this, when we have monthly data reports, sometimes it can be taken from a small survey sample and then extrapolated to a kind of entire population. And the revisions later take more comprehensive things like tax data for businesses or households. But if those survey response rates are lower, there's a more difficult margin of error to deal with. And so have you found that the pandemic has made your initial estimates less reliable, maybe because of these lower survey response rates? And there's something where the final estimate of the Atlanta Fed GDP Now model is just that much more different than a revision a few years in the future?
There's a couple of things to unpack there. I would say it has been less accurate since the pandemic than it was before. I mean, especially in kind of the 2021-22 range. But I would say other professional forecasters were less accurate than before. And so unpacking the reasons for that, there's probably multiple factors that are operating there. And one of them might be just changes due to the pandemic, changes in kind of spending patterns and even seasonal patterns. Some of this might be related to response rates going down for some of these surveys as well. It's kind of hard to disentangle all of those things, I would say. I would say generally speaking, kind of the patterns haven't, except for it being inaccurate and kind of more inaccurate in kind of the 2020s, post 2020 than it was before. I would say it hasn't changed dramatically since then. And even then, the accuracy's probably gotten a little closer to the kind of the pre-pandemic norm over the past year and a half or 2 years or so than it was before that. Within the monthly data itself, I might miss on its predictions more of that, but it's kind of hard to, because the pandemic kind of happened at the same time as the survey collection. Comprehensiveness went down, you can't really separate the two of those things. So it's kind of hard to, say what part of it's due to the survey collection rate going down and what part of it's due to these other changes. There isn't really a good way to answer that, unfortunately.
I think something that's also really interesting about the GDPNow model is that when you update it, you don't just update that point forecast for what quarterly GDP growth is going to be. You really break it down by estimates of components. And so I'm curious, are there components that tend to be more reliable and then those that tend to give your model the most trouble? So for example, do you find that the monthly inventories data does not really map well onto what's finally reported in the advanced GDP release? Or the consumer spending from PCE and retail sales is a very, very reliable way to come up with that estimate for personal spending? What can we say about the different components and what the GDPNow model is able to predict well and predict kind of with a large margin of error?
Yeah, so I would say it was the case prior to the pandemic that it was the retail sales to goods. There wasn't a whole lot of uncertainty. Relative kind of how big a contributor to GDP growth it is. You would get a very good estimate from the retail sales to the goods PCE part. And that's still probably the case, but maybe a little less so than it was before. But generally speaking, the consumer spending numbers are probably better than kind of some of the other subcomponents. The forecast from the model and even from professional forecasters, generally speaking, gets better as you get closer to the GDP release, but there's still going to be, because of the kind of the inherent volatility of the inventory's contribution to GDP, there's still going to be a pretty large margin of error that just isn't quite as large as it is 3 months before the release. The day before is going to be better than it was 3 months ago, but it's still going to be pretty large. That's partly due because the data mapping is not perfect and partly because it's such a volatile part of GDP. The fixed investment parts of GDP, so something like residential investment, structures investment, especially, those are generally pretty good mappings from kind of the source data to the GDP data. And something like government spending might not be. The monthly data is not going to help a whole lot for that forecast. So that forecast is probably not going to be that much more reliable kind of the day before the GDP release than it was several months before that, I would say.
I think also some of the components, and I know you talked about how the BEA, they publish information about the deflators they use to convert from nominal dollar data to the inflation adjusted estimates. But some of them, I think inventories or maybe government spending, it can be pretty opaque about what you're deflating with, right? So government spending, the things that government is the final consumer for, that is a really wide range of categories. And I imagine that can complicate some estimates just because converting into inflation-adjusted terms is not always obvious and it can be pretty difficult.
I wouldn't disagree with any of that. Part of it is kind of separating the kind of timing of this when they appear on fiscal statements might not be when those. So if you allocate something within the monthly treasury statement, as it appears in a line item there, it might actually not be translated into activity kind of that very same month. For the prices, I would say maybe the prices, there's some part of uncertainty from that, but I would say a lot of it comes from just the nominal spending part as well. Even if you can measure the prices perfectly, I would say there's probably still would be kind of this big margin for error just kind of based on kind of the translation from the nominal government spending data. And then there's a bunch of it that there really isn't any monthly data at all that you can use.
To overly generalize and in very simple terms, I feel like the decade or so before the pandemic, a lot of economic variables were moving in a very predictable trend-like manner with few hiccups. And then, you hit the pandemic lockdowns in the spring of 2020, and suddenly we have all of these different obstacles that change those trends, whether it's a new pandemic wave, geopolitical shocks, and it became difficult to really rely on trend-like models. And so I'm curious, when you talked about how you have to factor into the model, let's say big rebounds in 1 month that aren't going to happen next. One example is if terrible weather goes across the middle of the country in January and activity declines, and then there's a huge rebound in February, well, you intuitively know that that's not going to grow by the same rate in March. And so you need to kind of put in a human touch to the model and tweak the estimates. And I've got to think it's tempting to micromanage or to kind of have that human detailed touch for a lot of the model when you just feel like something feels off with your estimates. Do you update the model's mechanics very much as time goes on? How frequently? Or do you just try to place your faith in it and believe that its track record can speak for itself, and if you're wrong, then you're wrong?
Once we start the quarter forecast, once the first forecast is made for a particular quarter, then the model is fixed for the rest of that quarter, essentially. So it's never going to be the case that the forecast will change. The way the model works has been changed. Essentially, we want it to be kind of fixed within the quarter. There shouldn't be any judgment at all. There was a couple of changes in the pandemic made or after the pandemic, essentially, so that kind of the dynamics for the first few quarters of the pandemic don't kind of change the model too dramatically for kind of the post-pandemic period. And some of those would have, the model might have been more accurate if those had been made in real time, essentially. We didn't make until you were able to kind of make them with that kind of history in mind. So that with over, I would say, 2020, 21, 22, there's maybe 3 or so changes made that makes it so kind of the model behaves in kind of the same way that it did before the pandemic. And kind of those pandemic dynamics aren't kind of messing up the model going forward, essentially. Before that, there was probably one change every 2 years or something like that. So it might have been changed 3 times. Some of that's just kind of if we see kind of a data series that can be used that we hadn't been using before, something like industrial production of utilities, the forecast, consumer spending for utilities, things like that. We made changes like that. But I would say for the most part, it still isn't too dramatically different from what it was even 10 years ago.
Now, I know that the official policy is from the Fed is that the GDPNow model is not any official forecast of the Federal Reserve or the Atlanta branch of the Federal Reserve. But do you end up collaborating with any of the other Fed researcher staff on their own forecasting? Because I know each FOMC participant has a staff. There's just an army of very qualified and smart PhD economists going through the Fed, and everyone has their own different sense of what the best model is. Does the GDPNow model end up working in collaboration with all of those other people, or do you find that it is just something you publish on the site and you kind of work on your own as an island, so to speak?
I would say there's a few things like conferences or discussions. I wouldn't say there's a lot of that, but most of that's kind of academic. You would think more from kind of a statistician's perspective, what's the best way to design the model, kind of from a mathematical or statistics perspective. I would say not a whole lot of that, but some there has been. And then over time, presenting at conferences and things like that. I would say within a quarter or discussing a particular forecast, is this quarter's forecast, things that doesn't really take place. Kind of put out the number and then people can look at it and use it or not use it to that extent. I don't really have any insight how that's used or not by others.
Yeah, that makes sense. I mean, I guess the Fed likes to talk about not relying on one indicator or one financial conditions index, for example. So I guess it helps paint a broader picture for monetary policy people or just financial market analysts like those of us at FHN Financial. Patrick Higgins, thank you for coming on the podcast.
All right, thank you.
That was Patrick Higgins, policy advisor and economist at the Federal Reserve Bank of Atlanta. Something important that Patrick pointed out is that GDPNow and other economic forecasting models have gotten more accurate as pandemic disruptions have continued to fade. In the early part of the pandemic, there was so much month-to-month data noise and one-off issues that it was difficult to get an accurate view of the underlying economic fundamentals. Now, those issues have declined, and it's a lot easier to use data to gauge the health of the economy in real time. The September 18th Fed meeting will be the biggest macro event over the next 2 weeks. The Fed is widely expected to cut rates at the meeting, so the focus will be on the FOMC's latest Summary of Economic Projections, or SEP, and Chair Powell's press conference afterwards. While Fed officials and market participants are generally in agreement that the worst inflation is in the past, the Fed has generally viewed recent labor market weakening as healthy normalization rather than the early signs of a recession. In contrast, Fed funds futures have been pricing in a jumbo-sized 50 basis point cut at one of the 3 remaining meetings this year for much of the last month. The August CPI will be released next week, expected to firm confidence that inflation is on a sustainable path to 2%. Recent months have shown enough improvement to permit Fed easing at its meeting next month, but any surprises could shape how FOMC participants finalize their projections in the next SEP. Likewise, with consumer spending powering the economic resilience during the last couple years of Fed tightening, the September 17th retail sales report will be a key indicator of economic strength midway through the third quarter. On the political front, Vice President Kamala Harris and former President Donald Trump are scheduled to square off for their first debate on September 10th. The last debate, of course, on June 28th, was bad enough for President Biden that he eventually dropped out of the race. The race between Harris and Trump is seen as a toss-up by most election forecasting models and prediction markets, so even marginal changes in appeal to swing voters could make a meaningful difference. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.